In this course, we're going to be talking about Roth IRA and pre-tax IRA retirement account types. These are two of the largest retirement account types. They're the most widely used in the United States. We're going to define what they are, how money goes in, how money comes out, and understanding these two account types is really foundational to retirement planning. Many of the strategies and opportunities that are in this course revolve around how to get money in or how to get money out of these accounts in the most tax efficient way possible. So while this is relatively basic in terms of introducing the two account types, it's very important to understand for the rest of the course material. So we will begin with the key difference between a Roth IRA and a pre-tax IRA. The Roth IRA, you contribute after-tax dollars, meaning you earn your income, you pay your taxes, and you take those after-tax dollars and contribute it to a Roth. Conversely, a pre-tax IRA, as the name implies, you put in pre-tax dollars. This is a key difference between the two types of retirement accounts. Now, there are many more differences between them that are also important, but this is the primary difference between the two. When it comes to a Roth IRA account, the tax treatment for the contributions, as we had mentioned, are after-tax dollars. So you'll pay taxes on your income and you contribute those, and you do not receive a tax deduction for any contributions that go into a Roth IRA. Now, that being said, once the money is in a Roth IRA, it grows tax-free. And this is significant. Tax-free growth is very powerful. To put this in perspective, let's say you have a 9% rate of return in your investment account versus 8% return in your investment account. The 9% account will actually grow to be 32% larger than the 8% account over a 30-year period. That 1% difference between 9% and 8% could be just the tax drag from normal taxable investments. So this tax-free growth over a long period of time could amount to a substantially larger account than you would suspect from the simple tax savings of growing tax-free. So it's extremely powerful with the Roth IRA. And it's really important to understand this growth dynamic because the tax-free growth is phenomenal. In addition to that, when you do go to withdraw those funds some 30 years later or whatever it may be, the withdrawals are tax-free. And this is a huge win because you have this colossal amount of growth potentially in your Roth IRA that you've never paid taxes on because it's went from your contribution amount. There's no capital gains, there's no ordinary income, etc. As it grows over the years. So the tax-free withdrawals is very, very powerful. Then a little icing on the cake, it's also tax-free for your heirs. When you inherit a Roth IRA and you pull money out, you also do not pay taxes. So the Roth IRA is a very powerful account type. The way that, there's a wide variety of account types with a Roth IRA as well. We'll cover those briefly here. We actually have a dedicated video on that as well. But there's an individual Roth account. This is one people most generally think of. This is where you open your own account. You know, you may do this at Vanguard or Fidelity, fill out the paperwork, and you contribute your own money into the Roth IRA account by writing a check each year, doing a wire transfer, ACH, whatever it may be. That's an individual Roth account. The other account types that also exist, there's also Roth 401ks, Roth 403bs, or Roth TSP. These are all employer-sponsored plans, but they all also have Roth varieties as well if your plan administrator allows this option. There's also Roth accounts for SEPs, simples, and solos. Now, this is just actually a small sample of the different types of Roth IRAs you could potentially have. And oddly enough, depending on which account type you have here, impacts things like contribution limits in any given year based on the account type. We'll cover that in more detail. But there's a wide variety of Roth account types inside that Roth IRA category. Now, how money goes into a Roth IRA account? We've already talked about this briefly, but you can contribute money into an IRA. That's where you just write a check from your own earnings or whatever it may be, and you put cash into the Roth IRA account. Contributions are a very common form of funding a Roth IRA. Now, they have contribution limits, both in terms of income and how much you can put in. And again, it depends on the account type, but contributions is one way that you get money into a Roth IRA. Another way that you can get money into a Roth IRA is through a conversion. Now, a conversion is where you take a pre-tax IRA and convert it into a Roth IRA. Generally, if you're retired, you would do this by paying taxes on that pre-tax amount as you pull the funds out and roll it into a Roth IRA. That's a conversion when you're in retirement. There's also something called backdoor conversions, where you actually put money into a pre-tax account and then convert it into a Roth IRA. This does some interesting things like circumventing contribution limits, as well as income restrictions and whatnot. So there's two different ways to get money in: contributions and conversions. You also may end up with money in a Roth IRA through an inheritance, if you inherit one of these. And then last but certainly not least is from a rollover. A rollover is really just a way of thinking of an account transfer. So let's say you have a Roth 401k at your employer. You quit and you're no longer working there, and you just want to move it into into an individual Roth IRA. You can perform that rollover and just move the funds from the Roth 401k over to the individual Roth IRA. And that would be a way to move the funds from one place to another. So these are ways that you can get money into Roth IRA accounts. Contributions and conversions are the most common and the most interesting in terms of strategies. Now, how money comes out. If all the conditions are met, you have tax-free withdrawals. And I did mention here, if the conditions are met. The most common is turning 59 and a half, and now you can pull money in or out as you see fit. There are other ways you may potentially make tax-free withdrawals, such as a first-time home purchase or educational purposes. We're not going to cover those, but in general, the way that these are used the majority of the time is people pull the funds out in retirement, and it's totally tax-free. And so that's a really important dynamic of the Roth IRA. Moving over to the pre-tax IRA, the tax treatment for these is a little bit different. Obviously, pre-tax dollars are contributed, but what's different about this is you receive a tax deduction on your contributions, so it lowers your taxable income in the year that you make those contributions. You also receive growth tax-free, so it's very similar to, actually a better way to phrase this would be tax deferred. So it grows without paying taxes each year, but those taxes are simply deferred. And the reason for that is when you go to make those withdrawals, it's taxed as ordinary income. And that is a colossal difference between the Roth IRA and the pre-tax IRA. Having your withdrawals taxed as ordinary income is a major strike against a pre-tax IRA. While you're working and you're receiving these tax deductions, they can be attractive accounts for retirement. Once you're retired, in our opinion, the pre-tax IRA becomes the worst account that you have. And the reason for that is all future growth will be taxed as ordinary income. While it is deferred, it ends up getting taxed when you pull it out as ordinary income. A regular taxable account actually has more favorable tax treatment than this once you've hit your retirement years. And then another strike against it as well is your heirs will end up paying ordinary income tax on the withdrawals. Now, the fact that you end up paying ordinary income on the withdrawals actually opens up a world of planning opportunities and strategies to try to minimize these taxes. There are clever things you can do to make withdrawals during low income years, or keeping your income low on purpose to get money out of these things at the lowest tax rates you can. There's a lot of different strategies you can implement to try to avoid as much tax as possible here. But in general, your pre-tax IRA, once you are retired, ends up being an account type where you could have considerable taxes, and a lot of planning needs to go around these. The pre-tax IRA account types are basically a mirror image of the Roth. You can have an individual traditional account. These are often called traditional IRAs. You'll see that very, very commonly. You also can have a 401k, 403b, or TSP that are all pre-tax. Sometimes it'll be a traditional 401k, etc. That's just to differentiate from the Roth counterpart. So if you tell someone, oh, I have a 401k account, a lot of times they don't know, is that a Roth 401k or is it a pre-tax 401k? And so just specifying that can be helpful because the account types are so similar. You also have SEP Simple and Solo as options here as well. Again, just like the Roths, these have different contribution limits and rules as well. So those are the different account types. How money goes into a pre-tax IRA. As we had mentioned, you can contribute pre-tax dollars, and that lowers your income during that particular year that you made the contribution. However, as you can see, the next one is inheritance. For the Roth, the second bullet was conversions. There is no conversion to get money into a pre-tax IRA, unlike the Roth counterpart. And the reason for that is when you do a conversion to a Roth, you're taking a pre-tax and converting it into a Roth. There's nothing that can go from a Roth account back to a pre-tax, and you would never want to do that anyways. So, excuse me, conversions is not a way to get money into a pre-tax IRA. You have to do contributions. Another way that you could end up with pre-tax dollars is through an inheritance. And then last but not least, you can also do rollovers here. So if you have that pre-tax 401k, you can roll that into a traditional IRA once you're no longer employed and you meet the rollover rules. So these are 3 ways that money can go into a pre-tax IRA. How money comes out? If the conditions are met, meaning you're 59 and a half, you would pay ordinary income tax on that. Again, this is a big strike against the pre-tax IRA. So you want to try to time when you pull money out of your pre-tax IRA during the years where you have the lowest income brackets. The second way that money comes out of a pre-tax IRA is something called required minimum distributions. We did not see this in the Roth IRA counterpart. There are no RMDs, or required minimum distributions, for Roth IRAs. This is unique to pre-tax accounts. Required minimum distributions are something that the government mandates so that you begin pulling money out of these accounts so that they can collect taxes in your lifetime. When RMDs begin depends on your age. Today, it's generally between ages 73 or 75, depending on your birthday. But when you turn that RMD age, you're required to pull out a certain percentage of your account. And we have a dedicated video on RMDs and how they work. But that is another way that money comes out of a pre-tax account. So these are the 2 ways money comes out. When we think about which account is better, this is just our opinion and it is situational, but in general, a Roth IRA is almost always superior to a pre-tax IRA, including during your working years. We think that it is rare that a pre-tax IRA is going to be superior to a Roth IRA. So if you're trying to decide which one to contribute to and you're unsure, the Roth IRA is almost always better. Now, there are instances where the pre-tax may be more advantageous. I'll just list a few. The pre-tax may be better if you are in the highest income bracket today, and it has to be the highest, not a high bracket, but if you're in the highest bracket, there's a strong argument that pre-tax contributions may be beneficial. Another instance where pre-tax may make sense is if you're at the end of your career, you do have a high income and you're confident that your income will go down. This one is a little bit less common. And the reason for that is what we have observed is people's expenses tend to not drop when they're in retirement. And so if you're living off of a certain amount of income that you've grown accustomed to for 30 or 40 years, when you retire, you tend to have the same lifestyle, if not a little bit more, with travel and doing things with grandkids, etc. And so income, your expense requirements may actually go up. So we don't find this one to be true all the time. But if you know you're at the end of your career and you're confident your income is going to go down, so your tax brackets will go down, it may make sense to do pre-tax contributions and then do Roth conversions post-retirement. Last but certainly not least is to do pre-tax contributions if you cannot contribute to a Roth. The income restrictions for contributing to a Roth in most instances are a bit more strict than for pre-tax accounts, particularly if you have an employer-sponsored plan. Pre-tax is usually pretty straightforward and easy, whereas getting money into a Roth account gets more complicated as your income goes up. So in our opinion, the Roth IRA is almost always superior in terms of which one to contribute to, but there may be unique instances where pre-tax contributions may be better, but we think those are less common. So that's just a high-level introduction to the Roth IRA and the pre-tax IRA. We'll talk specifically about different account types, contribution strategies, etc. In more detail.